Hey, how's it going? This is Murray, and I wanted to shoot this quick video. If you are thinking about refinancing, or if you've recently refinanced in the last couple of years, this video is for you. Now, the reason people want to refinance, obviously, is you want to get a lower interest rate. And why is that? Because the payments you make are lower when you have a lower interest rate, and therefore your cash flow is better. So I'm a huge fan of better cash flow. But really, you need to stop and think, how much interest are you actually paying? And the purpose of this video is to show you what are you actually paying when you look at an amortization schedule that's behind the math of your new mortgage. Um, this is incredibly enlightening for me. Now, I used a site called mortgagecalculator.org. There's dozens, if not hundreds of sites that will do the math for you. And I summarized it in an Excel spreadsheet for you. All right. So we're going to assume we're going to do a case study on a $320,000 home that's been refinanced for 30 years at a 2.75% interest rate, which is not bad. That works out to be a payment of $1,306 a month. Okay. So what are you actually paying in interest? You think you have a 2.75%. Well, you do have a 2.75% mortgage, but what are the actual interest rates you're paying? I summarized the first 7 years of payments that you're going to make. And after the first year, you're going to be paying $8,713 of interest versus $6,964 of principal. That's a 56% interest rate. That means 56% of all the money you're paying off this loan is going to interest. That's money you don't get back. That's money you worked hard to get. And yes, the bank is giving you the privilege of borrowing money so you can buy or refinance a home. But are you aware of the math about how much you're actually paying? Now, I took a 7-year total here. The reason I took 7 years is because banks know that the average homeowner has a mortgage for about 7 years. Why 7 years? Because after 7 years, they either move or they refinance. So banks conveniently have constructed the mortgage calculation so that the first 7 years are significantly skewed toward interest payments. If you didn't already know that, the math is unbelievable. If you hang in there for 7 years, your interest rate is going to be 52%. That's a lot higher. Remember, you thought you're paying 2.75%. So I just want to make sure you're aware of the math. Even if you hang in there after 30 years, you're going to ultimately be paying 32% interest, which is $150,000 on a $320,000 home. That is a large number. So I'm going to suggest to you, before you refinance, or even if you've recently refinanced, instead of refinancing, wouldn't it make more sense to at least look at the potential for paying off your home completely in 5 to 7 years without changing your lifestyle or without changing your budget? Wouldn't it make more sense to at least evaluate that scenario and significantly reduce the amount of interest you pay? I recommend highly that you give me a chance to show what we can do for you. In my case, I saved $110,000 of interest payments, and I reduced my mortgage which has been refinanced several times, from 30 years down to 7. It's a game changer for me, and I think you owe it to yourself to look at to see what we can do for you. So this is Murray Bollier. Thank you for watching. I look forward to hearing from you soon.